Do you know the difference and similarity between traditional finance and behavioral finance? But wait. Before that, let's check our knowledge about traditional finance and behavioral finance. Traditional finance. Traditional finance is an approach to understanding financial markets and investment decision-making that is based on the principles of rationality, efficiency, and risk aversion. It is grounded in the efficient market hypothesis, EMH, which posits that financial markets are efficient and that asset prices fully reflect all available information. In other words, under the assumptions of traditional finance, all relevant information is quickly and accurately incorporated into asset prices, making it difficult for investors to consistently beat the market through active trading or stock picking. Some key characteristics of traditional finance include: 1. Rationality. Traditional finance assumes that investors are rational and make decisions to maximize their utility or wealth. It is believed that investors objectively evaluate all available information before making investment choices. 2. Market efficiency. Traditional finance views financial markets as efficient, meaning that asset prices always reflect their intrinsic values based on available information. As a result, it suggests that it is challenging to consistently outperform the market through active management. 3. Diversification and risk management. Traditional finance advocates for diversification as a way to manage risk. By holding a diversified portfolio of assets, investors can reduce exposure to idiosyncratic risks and protect their investments from significant losses. 4. Passive investing. Passive investing is a common strategy in traditional finance, where investors aim to replicate the performance of a broad market index or a specific asset class rather than attempting to beat the market through active trading. Now, let's look at behavioral finance. Behavioral finance is a field of study that emerged in response to the limitations of the assumptions made in traditional finance. It incorporates insights from psychology and behavioral economics to understand how cognitive biases and emotional factors influence investor behavior and decision-making. Some key characteristics of behavioral finance include: 1. Biases and heuristics. Behavioral finance recognizes that investors are not always rational and may be influenced by various cognitive biases and heuristics. These biases, such as overconfidence, loss aversion, and herding behavior, can lead to suboptimal investment decisions. 2. Market anomalies. Behavioral finance identifies market anomalies and patterns that contradict the assumptions of market efficiency. These anomalies may result from the systematic biases exhibited by investors, leading to mispriced assets and potential opportunities for abnormal returns. 3. Emotional factors. Behavioral finance considers the impact of emotions, such as fear and greed, on investment decision-making. Emotional biases can drive investors to make impulsive decisions that deviate from rational choices. 4. Inefficiencies. Behavioral finance suggests that financial markets may not always be fully efficient due to the presence of biased investors. These biases can create inefficiencies and mispricings, offering potential opportunities for skilled investors to exploit. 5. Behavioral strategies. Behavioral finance research has led to the development of behavioral finance-based investment strategies aimed at taking advantage of market inefficiencies caused by psychological biases. In short, traditional finance assumes rationality, efficiency, and market equilibrium, while behavioral finance considers the impact of psychological biases and emotional factors on investor behavior and market outcomes. Both fields contribute to our understanding of financial markets, with traditional finance focusing on efficient markets and rational decision-making, and behavioral finance delving into the complexities of human behavior and its effects on financial decision-making. Are we clear? Yes. Now let's understand the difference and similarity between traditional finance and behavioral finance. As we know, traditional finance and behavioral finance are two distinct approaches to understanding and explaining how financial markets work and how investors make decisions. While they share some similarities, they also have significant differences in their assumptions, theories, and perspectives. Let's explore the key differences and similarities between the two. 1. Assumptions. Traditional finance. This approach is rooted in the efficient market hypothesis, EMH, which assumes that financial markets are efficient and that asset prices fully reflect all available information. It assumes that investors are rational, have access to all relevant information, and make decisions to maximize their utility. Behavioral finance. In contrast, behavioral finance challenges the assumption of rationality and perfect market efficiency. It recognizes that investors are prone to psychological biases and may not always make rational decisions. It incorporates insights from psychology and behavioral economics to understand how cognitive biases affect investment behavior. 2. Investor behavior. Traditional finance. Traditional finance assumes that investors are rational and always act in their self-interest to maximize wealth. It relies on models that assume utility maximization and risk aversion. Behavioral finance. Behavioral finance acknowledges that investors often deviate from rational behavior and are influenced by emotions, heuristics, and biases. It seeks to identify and understand these psychological factors that lead to suboptimal decision-making. 3. Market efficiency. Traditional finance. This approach assumes that financial markets are efficient, meaning that asset prices always reflect all available information, and it is difficult for investors to consistently outperform the market. Behavioral finance. Behavioral finance challenges the notion of market efficiency by showing that investor biases and irrational behavior can lead to market anomalies and mispricings. These mispricings create opportunities for skilled investors to outperform the market. 4. Investment strategies. Traditional finance. Traditional finance advocates for passive investing and the use of diversification to manage risk. It suggests that investors should buy and hold a diversified portfolio of assets that aligns with their risk tolerance and investment horizon. Behavioral finance. Behavioral finance acknowledges the limitations of passive investing and recognizes the importance of understanding and managing behavioral biases. It encourages investors to be aware of their cognitive biases and emotions to make better decisions. Additionally, behavioral finance may lead to the development of active investment strategies that exploit market inefficiencies caused by irrational behavior. 5. Decision-making process. Traditional finance. Traditional finance assumes that investors gather all available information, objectively evaluate it, and then make rational investment decisions based on expected returns and risk. Behavioral finance. Behavioral finance highlights that investors often make decisions based on emotions, cognitive shortcuts, heuristics, and social influences. It examines how these biases can lead to deviations from rational decision-making. Now, let's look at the similarities of both of them. 1. Both traditional finance and behavioral finance are concerned with understanding investor behavior and how it impacts financial markets. 2. Both fields aim to offer insights into the factors that drive asset prices and investment decisions, albeit through different lenses. 3. Both fields recognize the importance of risk and return in investment decision-making. In summary, the key difference between traditional finance and behavioral finance lies in their assumptions about investor behavior and market efficiency. Traditional finance assumes rationality and market efficiency, while behavioral finance considers the impact of psychological biases and market anomalies. Both approaches have their merits and are valuable in understanding different aspects of financial markets and investor behavior. Did you find this video helpful and informative? If yes, then don't forget to like, comment and subscribe for upcoming insightful videos. Till then, stay tuned and keep watching.